Welcome to the research desk.
It's really great to be diving into this one today. We've got a lot to unpack.
We really do. Because, well, let's start with a visual. If I handed you a portfolio that was entirely composed of, let's say, 60 pounds of live fireworks and 40 pounds of soft pillows, you would never in a million years call that balanced.
No, obviously not. You'd be staring at the fireworks the whole time.
Right. You would look at the sheer destructive potential concentrated in those fireworks, and you would intuitively understand that the pillows are, they're completely irrelevant to the overall danger of the room.
They are just taking up physical space.
Exactly. Yet, right now, sitting inside your retirement account, your state pension fund, your university endowment, is exactly that structure. Today, we are dismantling a universally accepted financial illusion.
Yeah, it really is an illusion. We're examining the deep, largely hidden difference between capital balance and risk balance.
And the framework guiding our exploration is this landmark academic paper, Leverage Aversion and Risk Parity, by Clifford Asness, Andrea Frazzini, and Lasse Pedersen. This research, it basically forces every single person who interacts with financial markets to confront a massive contradiction in modern portfolio theory.
A huge contradiction. Because a traditional portfolio, the classic 60% corporate stocks, 40% government bonds split, it looks incredibly moderate and responsible when you measure it purely in dollar amounts.
Right. It looks like the sensible, boring middle ground of wealth management.
But underneath that placid surface, mathematically speaking, it behaves like one massive, highly volatile equity bet.
And conversely, you have this framework known as risk parity. And risk parity looks entirely bizarre and frankly kind of terrifying to traditionalists.
Oh, absolutely, because it involves owning huge amounts of low volatility assets, like short-term bonds, and this is the scary part for a lot of people, systematically applying leverage, borrowed money, to scale up the total risk.
Yeah, to the uninitiated, relying on leverage sounds like gambling. But I have come to the realization, and it's a realization that fundamentally altered my view of markets, that risk parity is actually a structurally superior framework.
Well, we'll see about that.
I mean it. It exposes the fatal flaw of modern portfolio theory, which is human leverage aversion. By balancing the actual mathematical sources of risk rather than just the dollar amounts of capital, it captures these systematically underpriced returns in safer assets.
It certainly attempts to.
It proves, with really devastating clarity, that the traditional market portfolio we are all taught to revere is decidedly not the optimal risk portfolio.
Look, I'll admit, the mathematical elegance of the risk parity framework is undeniably seductive. I completely understand why it altered your perspective. The paper brilliantly identifies a very real behavioral and institutional constraint.
It diagnoses a fundamental human truth.
It does. It correctly diagnoses that human beings and massive financial institutions are either terrified of or legally forbidden from borrowing money to invest. But while I agree that measuring a portfolio strictly by its dollar allocation is a deeply flawed practice, risk parity is not the holy grail its proponents claim it to be.
How can you say that when it fixes the core imbalance?
Because it simply trades one well-understood vulnerability for a host of new, dangerous, and poorly understood fragilities. It trades equity concentration for a deep structural reliance on leverage mechanics, immense duration risk, and the lethal breakdown of historical correlations.
But those are manageable risks.
Replacing equity risk with leverage and duration risk is not a free lunch. It is a highly complex, highly precarious relocation of pain. When you scale up safe assets with leverage, you are making a massive, silent structural assumption about the macroeconomic weather.
Which is that assets behave differently in different environments.
Now, the assumption is that the historical relationship between stocks and bonds will remain intact forever. And as we have recently witnessed in the global markets, when an exogenous inflation shock causes both stocks and bonds to crash simultaneously, well, that elegant mathematically balanced machine becomes a wealth-destroying trap. The 60-40 portfolio may be an illusion of balance, but risk parity is an illusion of control.
Okay, to break down exactly why that control is not an illusion,
but rather a fundamental correction of market pricing. We need to anchor this abstract theory in a profoundly simple physical space.
All right, let's hear it.
I want you to imagine a grocery store. Imagine two different shoppers walking into this massive supermarket with the exact same goal. They both need to prepare a large, satisfying, high-calorie meal for a banquet.
Okay, two shoppers, same calorie target.
Right. Now, the first shopper is completely unconstrained. They are handed a massive, industrial-sized shopping cart. Because they have virtually unlimited space, they can perfectly balance their meal.
They can buy whatever they want.
Exactly. They can buy a massive volume of nutritious, low-calorie staples, rice, vegetables, lean proteins, mixing and matching whatever ingredients they need in whatever quantities they desire to achieve the perfect balance of flavor, nutrition, and total caloric volume.
Makes sense.
Now, look at the second shopper. This shopper is handed a tiny, rigid handbasket and given a strict rule by the store manager: you are absolutely not allowed to use a larger cart. No extra bags, no borrowing a cart from a friend. Your volume is strictly capped.
So they are structurally constrained.
Exactly. If this constrained shopper wants to achieve that same massive, high-calorie meal for the banquet, they are mathematically forced to abandon the balanced, nutritious staples. Rice and vegetables just take up too much physical space for the calories they provide.
Right? They won't hit their calorie target with lettuce.
Right. To hit their caloric target within the confines of that tiny basket, they have no choice but to load up on the absolute most calorie-dense, spiciest, most heavily concentrated items on the shelves. Pure butter, heavy cream, raw sugar.
It's forced behavior.
It is a choice forced by physical constraint, not preference. Now, if you are listening to this and wondering what a grocery cart has to do with your retirement, you are that second shopper. In the financial markets, the size of the shopping cart is your ability to use leverage.
The basket size is your balance sheet.
Yes. Because the vast majority of investors are legally, institutionally, or psychologically restricted from borrowing against safe, steady bonds to reach their 7 or 8% return targets, they crowd into high-beta, highly volatile equities.
They buy the heavy cream.
They systematically overpay for the spiciest, most volatile assets on the market, simply because it is the absolute only way to make the meal big enough without using a larger cart. Risk parity corrects this fundamental pricing distortion.
By getting a bigger cart.
Right. It operates on the principle that you must first perfectly balance the heat or the risk of the ingredients, and only then do you turn up the dial using leverage to reach the desired return. It is a stunning realization that because of this structural, universal constraint on borrowing, the basic prices of assets in our markets are completely warped.
I'll give you this. The grocery store is a brilliant conceptual anchor. It perfectly illustrates the behavioral thesis of the Asness paper. But it completely glosses over the physical, mechanical reality of what that larger cart actually entails in the real world of finance.
It's just borrowed capital.
But you describe leverage as if it were simply a frictionless expansion of space, like a purely sterile mathematical input that magically expands the volume of a portfolio without altering its fundamental substance. That is the fatal catch in this entire framework.
How so? It expands the balance.
Because leverage is not a sterile input. Leverage has weather of its own. It has its own gravity, its own aggressive liquidity demands, and its own unforgiving margin calls. Let us stay in your supermarket for a moment.
Okay, let's walk down the aisles.
Imagine that the massive industrial cart you handed the first shopper is not free. Imagine it is rented, and the rental fee fluctuates every single minute based on the mood of the store manager.
Okay, financing costs. Fair enough.
Furthermore, imagine that as the value of the groceries inside the cart temporarily dips, the store manager runs down the aisle, violently shakes the cart, and forces you to throw your groceries onto the floor at a massive discount just to keep the cart.
That's a bit dramatic, but I see your point about margin calls.
That is exactly what leverage actually feels like. The 2022 market shock delivered a violent historical education on this exact mechanism. It proved that when you scale up seemingly safe assets like government bonds with massive amounts of leverage and then an exogenous macroeconomic shock hits,
Like the inflation spike.
Yes, a sudden generational spike in inflation. It causes the prices of both stocks and bonds to collapse simultaneously. Your larger shopping cart suddenly catches fire in the middle of the frozen food aisle.
But that's an extreme tail event.
But when it happens, you are forced to liquidate your beautifully balanced assets at the exact moment they are plummeting in value, purely to maintain the leverage ratios demanded by your prime broker.
Which traditional investors don't have to deal with. True.
Exactly. The traditional 60-40 investor holding the fireworks and pillows may suffer a severe, painful drawdown and a market crash, but they own their assets outright. They can simply sit on their hands, endure the volatility, and wait for the recovery.
They just ride it out.
Right. They are generally not forced to sell at the absolute agonizing bottom just to survive. The risk parity investor, however, is heavily reliant on continuous, cheap, uninterrupted financing to maintain that expanded cart. They face existential structural risk. We must clearly establish right here at the outset that risk parity is not a magical elimination of risk. It is the deliberate, calculated trading of equity risk for financing risk and correlation risk.
You know, I have to admit, when I first confronted the reality of margin calls and financing costs, my immediate thought was very similar to yours. I assumed the structural drag of borrowing would just consume any theoretical benefit of balance.
It's a very logical assumption.
To truly understand why that trade, swapping equity risk for financing risk, is fundamentally logical and, importantly, historically compensated, we have to look much closer at the 60-40 mirage. We have to dissect in granular detail why a portfolio comprising 60% equities and 40% bonds is a masterpiece of false advertising.
False advertising is a strong term.
But it is. Let us go back to the storage room with the fireworks and the pillows. You are a fiduciary, you look at the ledger, and you are told the room is perfectly balanced because it contains exactly 60 pounds of fireworks and exactly 40 pounds of soft pillows.
By pure weight, it seems prudent.
By pure weight, by sheer capital allocation, yes. But the danger, the actual embedded risk variance of that room, is entirely concentrated in the fireworks. Equities are the fireworks. They jump around, they spark, they suffer massive drawdowns.
Fundamentally, corporate equities exhibit a price volatility that is 3, 4, sometimes 5 times greater than high-quality government bonds. Because of that massive inherent disparity in share volatility, the 60% equity sleeve dictates almost all of the portfolio's actual movement.
It's the dominant driver, absolutely.
If stocks have a terrible month, the portfolio has a terrible month. If stocks have a great month, the portfolio has a great month. The bonds are just sitting there. They act as a slight buffer, softening the blow by a few percentage points, but they are essentially powerless to dictate the overall outcome of the wealth.
They're the pillows.
Right. In a traditional 60-40 portfolio, equities are fundamentally responsible for something like 85 to 90% of the total risk variance. When we call this structure balanced, we are lying to ourselves and we are lying to our clients.
We are measuring the wrong metric.
We are rigorously measuring the shelf space while completely ignoring the danger. And the consequence of this lie is that traditional investors are walking into every macroeconomic storm completely naked, entirely dependent on the continuous, uninterrupted growth of corporate earnings to save them.
Well, we are indeed measuring shelf space rather than danger, and the reason we do so is not out of malice or stupidity, but because it traces directly back to the classroom theories that built the entire foundation of modern finance.
You're talking about CAPM? Specifically, yes. We have to talk about the Capital Asset Pricing Model, or CAPM, developed in the 1960s. This theory is the bedrock of how institutional capital is managed today. The theory mathematically dictates that there is one optimal market portfolio out there, a perfect, all-encompassing basket of all risky assets in the world, weighted exactly by their total market value. The theoretical ideal.
Right.
But the underlying foundational assumption of CAPM, The linchpin that holds the entire academic universe together is the idea that every single participant in the market can freely borrow or lend money at the risk-free rate.
Which is obviously a fiction in that frictionless academic utopia. If you want more return, you do not change the composition of the portfolio. You do not go out and buy riskier tech stocks. You simply walk into a bank, borrow money at the government treasury rate, and buy more of that exact same perfectly balanced global market portfolio.
But that's not how the real world operates.
Exactly. Step outside the halls of the university and look at the actual participants moving trillions of dollars in the real economy. A state pension board managing the retirement funds for hundreds of thousands of public school teachers often faces explicit, written statutory bans on using any form of leverage.
They literally can't borrow money.
They cannot. A mutual fund manager faces incredibly strict regulatory limits from the SEC. A wealth manager advising a retail client who is nearing retirement faces deep, evolutionary psychological aversions to the word leverage.
It sounds like a dirty word to them.
To a normal human being, the word leverage is inextricably associated with ruin, bankruptcy, and jumping out of windows during the Great Depression. Even the most sophisticated professional asset allocators face brutal career risk.
That's the agency problem.
Right. It is far easier for a chief investment officer to defend to a hostile board of directors that they lost money holding standard, blue-chip American equities during a global market downturn, because everyone else lost money too, than to sit in that boardroom and explain why they lost money in a highly complex, leveraged, algorithmic bond strategy that no one understands.
I failed doing what everyone else was doing.
Exactly. The real world is defined by absolute, unyielding constraints that the elegant academic models of the 1960s completely and conveniently assumed away.
And those real-world constraints are exactly what drive the massive pricing distortions that Asness, Frazzini, and Pedersen so brilliantly identified. Because these massive pools of global capital, these constrained pension funds, endowments, and tens of millions of retail investors, they still critically need high expected returns to meet their obligations.
They still need the big meal.
Right. They need the high-calorie meal, but they are entirely forbidden from using leverage to scale up a safe portfolio. So they only have one remaining tool left in the toolbox. They try to go faster by steering downhill.
Overweighting equities.
They systematically abandon the low-risk, high-quality assets and forcefully overweight high-risk, high-beta equities that crowd into the most volatile, speculative segments of the market simply because those assets inherently provide the leverage they are legally forbidden from accessing themselves.
A structural tilt.
And this systemic, forced, unnatural behavior physically alters the prices of assets across the globe. When trillions of dollars indiscriminately chase the highest risk assets purely because they cannot apply leverage to safer ones, they bid up the fundamental prices of those risky assets.
Meaning lower forward returns.
Exactly. When you bid up the price of an asset today, you are mathematically lowering its future expected return. You are overpaying for the right to hold that risk. Conversely, look at what happens to the safer, low volatile assets, the short-term bonds, the high-quality credit.
They get left behind.
They are left completely neglected because no institution without the ability to use leverage can possibly use a 3% yielding bond to hit an 8% actuarial return target. Those safe assets are ignored. They become structurally underpriced relative to the actual mathematical risk they carry.
The leverage aversion premium.
Yes, this is the profound invisible mechanism of leverage aversion. It creates an environment where investors are systematically, consistently undercompensated for taking raw equity risk and massively overcompensated for holding steady, lower-risk assets. This isn't just an academic theory. It is a structural inefficiency in the plumbing of global capitalism.
But we have to examine how this brilliant theory actually manifests when it is dragged out of the theoretical realm and exposed to cold, hard historical data. Because the transition from an elegant theory of human constraint to the empirical reality of portfolio management is where the cracks begin to show their teeth.
The data is incredibly robust, though.
Let's look at it. The authors of the paper presented an extensive, incredibly detailed historical analysis. They went all the way back to 1926 for the United States markets and 1973 for global markets, incorporating a vast array of asset classes: domestic stocks, international bonds, commodities, and corporate credit.
A massive sample size.
It is. and they constructed a mechanical, perfectly rigid, backward-looking portfolio based on inverse volatility. The methodology was essentially this. At every single monthly rebalance, the algorithm looked back at the previous 3 years of market data.
The trailing 36 months.
Right. It calculated exactly how volatile each specific asset had been over that 36-month window. It then mathematically assigned more capital to the steadier assets and less capital to the jumpier, more volatile ones. Finally, they theoretically scaled that entire constructed portfolio up using assumed leverage to match the exact total volatility of a traditional equity-heavy benchmark.
Which is the core mechanism of risk parity.
Yes, but while the math is flawless, this methodology is incredibly reliant on a deeply flawed assumption. It assumes that the recent past, specifically a rolling 3-year window, is a perfectly reliable map of the future. It assumes that volatility is a slow-moving, predictable, highly stable phenomenon that politely announces itself before it strikes.
So what actually happened? Think about this for a second when they ran this exact, systematic, mathematically rigid process across more than 8 decades of actual market history.
The backtest.
Right, the backtest. And we are talking about testing this algorithm through the absolute worst economic weather imaginable, the devastating depths of the Great Depression, the explosive post-war boom, the brutal grinding stagflation of the 1970s, the irrational exuberance of the dot-com bubble, and the catastrophic global financial crisis of 2008.
A lot of different market regimes.
Exactly. And over that entire chaotic span of human history, the backward-looking, risk-balanced approach consistently and profoundly outperformed the traditional market portfolio in risk-adjusted terms. It beat it across virtually every single decade.
On a risk-adjusted basis, yes.
This was not a statistical fluke. It was not a strategy isolated to one lucky 30-year bull run in U.S. Treasuries. It empirically demonstrated that balancing the actual risk contribution of assets fundamentally produces a superior Sharpe ratio over long horizons. It generates more return for every single unit of pain endured.
The Sharpe ratio is higher, agreed.
This empirical reality forces us to acknowledge something deeply uncomfortable. We are all taught in Finance 101 that the relationship between risk and reward is a straight upward-sloping line. The more risk you take, the more return you inherently deserve and receive.
The security market line.
Right, but the data proves that this line actually flattens out in the real world. The reward for taking raw, unadulterated equity volatility is heavily diminished precisely because constrained investors have mindlessly bid up the price of that volatility. The data proves that leverage aversion is not just a theory, it is a gravitational force that has dictated asset returns for a century.
I will certainly grant you that the empirical evidence over that specific historical window is compelling, and the outperformance in risk-adjusted terms is a mathematical fact. But, the fundamental mechanism they use to harvest that return relies on a conceptual sleight of hand that ignores the realities of regime change.
A sleight of hand?
Yes. Think of the market like a restaurant. You walk in hungry and you look at the menu. You can either buy a giant, oversized bowl of very average, uninspiring soup, which represents the equity market, or you can buy a tiny, exquisite cup of truly excellent soup, representing safe, high-quality, low-volatility assets.
Then you want the excellent soup.
Of course. But because you are constrained by your budget and cannot simply order 5 tiny cups of the excellent soup, you are forced to buy the giant bowl of average soup just to get enough calories to survive the day. Risk parity is essentially the mathematical realization that if you can somehow secure the outside financing, the leverage to buy multiple tiny cups of the excellent soup, you end up with a vastly superior meal overall.
Which makes perfect sense.
In theory. But here is the fatal flaw in the backtest. Its blind, unyielding reliance on a 3-year rolling window to define the quality of the soup. A 3-year look back creates an incredibly dangerous false sense of security. It explicitly assumes that the broader economic regime is static.
It assumes recent correlations hold.
Exactly. If you are a risk parity algorithm and you are using 3 years of placid, low volatility, highly profitable bond data to justify aggressively levering up your fixed income exposure to maximum levels, you are completely and utterly blind to a sudden, violent regime change.
like the one we saw recently.
Yes, when the macroeconomic tectonic plates shift overnight, when inflation suddenly spikes to 9% after 40 straight years of dormancy, that backward-looking volatility measure is worse than useless. It actively encourages you to hold maximum leverage right at the exact moment the asset enters a severe, unprecedented drawdown. You are driving a heavily loaded semi-truck down a mountain road, and your only steering mechanism is a rearview mirror that shows a straight highway behind you.
I understand the fear of driving via the rearview mirror, but that brings us directly to the core mechanics of risk budgeting, which is designed specifically to prevent the truck from going off the cliff.
Assuming the math holds up.
It does, but we have to clearly establish the absolute separation of heat and capital. Let us replace the restaurant with a cooking stove equipped with 4 different burners.
Okay, back to the kitchen.
The traditional capital allocation approach, the 60-40 model, simply looks at the physical size of the pots you are placing on the stove. It says, place exactly 60% of your total mass on burner A and 40% on burner B.
Just looking at the volume of capital.
Exactly. Risk parity asks a fundamentally different, far more intelligent, and far more dynamic question. How much actual, physical heat is each burner emitting right now? In financial terms, volatility and covariance act as the heat.
And covariance is key there.
Covariance is a crucial concept here, yes. It is not just how much an asset moves, but how it moves in relation to everything else. Are your stocks and bonds holding hands and jumping off a cliff together, or are they moving in opposite directions? And if burner A is emitting 4 times the thermal energy of burner B, putting even a slightly larger pot on burner A is going to entirely dictate the speed at which your meal cooks, or, more likely, burns to a crisp.
So you balance the heat.
Risk parity demands that we measure the heat first. It allocates capital in exact inverse proportion to the heat being generated by the asset, ensuring that each burner is contributing an equal amount of thermal energy to the overall process. This creates an inherently stable, perfectly balanced system.
But it's too slow.
Right. Here is the critical pivot. An unlevered risk parity portfolio, while incredibly safe and balanced, is totally inadequate for institutional return targets. It cooks too slowly. You will never meet your pension obligations with it.
You'll miss your 8% hurdle rate.
This is where we must aggressively separate 2 distinct decisions that traditional finance incorrectly merges into one lazy choice. First, you must determine the absolute best mix of risks, the most efficient combination of assets to maximize return per unit of actual pain.
The optimal portfolio.
Only after you have perfected that mix do you make the second, completely separate decision. How much total risk do you want to take? Leverage is simply the mechanism used to turn up the volume on a perfectly balanced mix. It is scaling excellence rather than settling for mediocrity.
And that right there is exactly where the illusion reaches its absolute peak. You use the word simply. You describe leverage as a pure, frictionless amplifier, a sterile volume knob you can just casually twist to hit a target return.
Mathematically, it is a multiplier.
On a spreadsheet maybe, but leverage is not a clean academic input. It carries a heavy, compounding, and deeply unforgiving invoice. When we look at the critical work of researchers like Anderson, Bianchi, and Goldberg, who have deeply analyzed the real-world application of these theories, they completely dismantle this exact perception.
They focused heavily on the implementation costs.
They expose the brutal, unglamorous plumbing of leverage portfolios. When you apply leverage in the real world outside of a spreadsheet, you are introducing a cascading waterfall of structural frictions. Let's define exactly what that plumbing looks like.
Okay, let's go through it.
First, you have constant financing costs. Borrowing money is not free. And when short-term interest rates rise, your cost of capital skyrockets, immediately eating into your spread.
Which did happen?
Second, you have stringent margin requirements. Prime brokers demand collateral, which forces the fund to hold significant amounts of uninvested cash. This is known as cash drag, which heavily dilutes your return.
It reduces the capital efficiency, sure.
Third, because much of this leverage is achieved through futures contracts, you have roll costs. A futures contract expires. When it does, the fund must sell the expiring contract and buy the next one. If the market is in contango, meaning the future price is higher than the spot price, the fund bleeds capital
every single time it rolls that contract over.
That roll yield can be painful.
And crucially, you have compounding drags, the mathematical decay that occurs when you dynamically lever volatile assets over time. If a levered asset drops 50%, it takes a 100% gain just to get back to zero. Leverage is an active, aggressive, and highly expensive participant in the portfolio.
But those costs are modeled.
It acts as a massive amplifier of structural friction that the theoretical models comfortably ignore. When you lever up an inherently low-returning asset like a short-term treasury bond by 300% just to match the volatility of a tech stock, a massive portion of the expected return is instantly vaporized by the sheer cost of the financing itself. You are building an incredibly complex, expensive, fragile machine just to recreate the returns of a much simpler one.
Look, I hear the critique of the plumbing, and I agree that implementation matters deeply. But you must look at what that machine is actually designed to do. That machine is designed to survive deeply diverse economic weather patterns, which is exactly why the macro environment balance is so critical.
The all-weather approach.
Yes, this is the underlying logic of Bridgewater's famous all-weather framework, which is fundamentally aligned with the risk parity philosophy. A traditional 60-40 portfolio is like a household that spends 60% of its entire monthly income on rent.
Very highly concentrated.
It represents a single, massive, terrifying point of failure. If rent goes up unexpectedly, the household is completely devastated. They have no flexibility. True, structural diversification spreads those fixed costs across rent, food, transport, and emergency savings.
So mapping that to markets.
In financial terms, different asset classes are structurally biased to perform in different macroeconomic environments. Corporate stocks perform beautifully in environments of rising economic growth and stable inflation. Nominal government bonds act as the ultimate ballast during periods of sudden disinflation or severe recessionary shocks when central banks slash rates.
Because yields drop and prices rise.
Right. And commodities and inflation-linked bonds thrive exactly when inflation surprises to the upside. Risk parity actively, mathematically balances the exposure to these deeply different macroeconomic drivers. It ensures that no single economic environment, whether it be a massive growth shock, an unexpected inflation shock, or a crippling deflationary spiral, can unilaterally destroy the portfolio.
It assumes the assets offset each other.
By applying leverage to this perfectly balanced macro foundation, you create a structure that is exponentially more resilient than simply crossing your fingers, buying the S&P 500, and hoping corporate equities continue to rise indefinitely. You are building a portfolio that is agnostic to the future, rather than one that bets everything on a sunny day.
But what happens when the hidden common denominator underlying all those carefully balanced assets turns out to be inflation and rate duration? I want to set the scene for the violent market shock of early 2022 because it is the ultimate stress test of this exact theory.
2022 was certainly an outlier year.
For the better part of a decade, risk parity managers built these massive, mathematically beautiful, highly levered portfolios operating on one fundamental, unshakable assumption. When economic growth falters and corporate stocks fall, nominal government bonds will catch a bid as a flight to safety, perfectly offsetting the equity losses.
Negative correlation.
Exactly. It worked flawlessly for 40 years of declining interest rates. But in 2022, the economic reality shifted violently. Central banks were suddenly forced to aggressively hike interest rates to combat rampant generational inflation. Let's explain duration risk simply. When interest rates go up, the price of existing bonds must go down, and the longer the maturity of the bond, the harder it crashes.
The math of bond yields.
Suddenly, the entire diversification engine of risk parity sputtered and died. Stocks plummeted because rising discount rates crushed corporate valuations. But crucially, heavily levered long-term bonds plummeted simultaneously because yields were surging. The safe assets, the very foundation that risk parity relies on, the assets it systematically levers up to massive proportions exhibited massive price volatility and fatally a strong positive correlation with equities.
They moved together.
They held hands and jumped off the cliff together. The pillars of the all-weather house collapsed simultaneously. The leverage that you claim was supposed to simply scale up a balanced return instead aggressively multiplied the pain across inherently correlated assets.
It was a very bad year for the strategy.
A perfectly balanced portfolio leveraged 3 times over becomes a disaster when all assets drop 10%. That is the sheer terror of relying on historical correlations. Correlations are not physical laws of the universe. They are temporary psychological regimes that can vanish overnight. And when they vanish, your perfectly balanced machine becomes a highly efficient wealth incinerator.
Okay. It is absolutely true that 2022 was a profound, deeply painful stress test for the industry, and the positive correlation between stocks and bonds caught many off guard. But we must analytically separate the permanent underlying insight of risk parity from the specific failures of overly levered ETF products or rigid, inflexible correlation models.
You think the core insight survives 2022?
Absolutely. The lasting lesson, the absolute permanent insight for the practitioner that Asness, Frazzini, and Pedersen delivered remains flawlessly intact. Risk diagnosis must take precedence over product peddling. The fundamental first step for any investor, whether they manage a billion-dollar endowment or a simple 401k, before they buy a single asset, is to measure their portfolio by its actual mathematical sources of pain, not its polite dollar allocation.
Measuring risk rather than capital.
Yes. Consider a standard retail client. They sit down with their financial advisor, and the advisor puts them in 70% U.S. equity, 20% international equity, and 10% bonds. The client looks at their statement, sees 3 distinct lines, and feels highly diversified. They feel safe.
The illusion of diversification.
Right, but if a macroeconomic shock causes global equities to drop 35%, that 10% bond sleeve is mathematically useless. It is a rounding error. It will not protect them. The emotional and financial devastation will be absolute, because 98% of their portfolio's risk variance was secretly concentrated in one single asset class, global corporate equity.
The fireworks.
Asness, Frazzini, and Pedersen provided us with the ultimate diagnostic tool to expose this lie. Even if an investor chooses not to apply a single dollar of leverage, which is a perfectly valid choice, utilizing the concept of risk contribution to understand exactly what is driving the volatility in their portfolio is an indispensable evolution in wealth management. It forces honesty. It forces you to look at the fireworks.
I agree entirely that the diagnostic value of this framework is profound. Recognizing true risk concentration is vital. But the danger, the insidious threat, lies in the set-and-forget mentality that the elegant mathematics of risk parity often breeds among allocators.
You have to monitor the regimes.
Measuring current risk is vital, but projecting historical risk into the future blindly is perilous. Respecting regime shifts and aggressively, constantly stress-testing your correlation assumptions is absolutely non-negotiable. Furthermore, we must recognize that the leverage aversion premium itself is a market outcome, not a law of physics.
It can get crowded out.
As hundreds of billions of dollars poured into risk parity strategies over the last decade, exactly because of papers like this, those formerly neglected low-risk assets became immensely crowded. The market adapted. This crowding fundamentally shrank the very premium the strategy was originally designed to harvest.
The practical takeaway has to be grounded.
The practical takeaway for the ordinary investor who is dissecting this complex academic debate is a strict mandate for structural simplicity. Keep the core of your portfolio simple and transparent. Use high-quality bonds strictly as a true ballast and only when the prevailing yield and duration risk mathematically justify their inclusion in your portfolio.
And tread lightly with borrowed money.
And above all, avoid the siren song of leverage unless you are massively capitalized and psychologically prepared to survive the absolute worst possible week in the history of the markets without facing a forced margin liquidation. Leverage demands perfection from the future, and financial markets are inherently delightfully imperfect.
Well, the discovery and precise quantification of leverage aversion as a systemic pricing distortion represents one of the most profound evolutions in modern finance. It permanently changes how we view the concept of diversification.
It completely reframes it.
It proves unequivocally that the revered 60-40 portfolio is very often just naked equity risk wearing a polite, socially acceptable disguise. By recognizing that human beings and institutions are fundamentally constrained by their deep-seated fear of borrowing,
we can logically, empirically explain why high beta, volatile assets are systematically overpriced and steady, boring assets are structurally undervalued.
The behavioral driver is undeniably real.
Risk parity is the brave, mathematical response to that psychological flaw. It demands that we balance our exposure to the actual elements of risk, the true heat of the burners, before we ever decide how large a meal we want to cook.
While the critique of capital balancing is entirely valid and necessary, we must remember the cost of the cure. Risk parity attempts to solve the problem of equity concentration by introducing a terrifying reliance on stable historical correlations and uninterrupted, infinite access to cheap leverage.
It's a complex machine.
The brutal, unforgiving reality of 2022 proved that when the macroeconomic environment turns actively hostile, leverage does not simply scale returns. It aggressively, violently multiplies the pain across seemingly safe, unrelated assets. The ultimate convergence here, the true lasting lesson of Asness, Frazzini, and Pedersen's landmark research, is not a simple, dogmatic conclusion that risk parity always wins.
No, it's about awareness.
It is a fundamental directive that investors must actively and rigorously balance their true sources of pain before they ever make a decision about how much total risk to assume. Once you internalize the profound difference between dollar weight and risk weight, you can never look at a conventional asset pie chart the same way again.
This is the Research Desk officially signing off.